Welcome to the Ownership Economy podcast, the podcast that explores the people and ideas that are utilizing technology, economics, and the law to reimagine how the economy can work for everyone. Here we connect with the entrepreneurs, investors, thought leaders, academics, and politicians that are constructing the ownership economy by expanding access to broad-based ownership and democratic governance. I'm Martin Smith, and I'm joined by my co-host, Jahed. We are two investors and operators that aim to use this platform to showcase the people and ideas that will shape a society that offers more economic opportunity for all. In today's pod, Jahed and I are joined by Mark Beylin from Myco. Myco is reimagining how communities collaborate, incentivize members, and share the financial benefits of success. Myco's work was heavily influenced by Mark's co-founding of Pixel Portraits, a collaboration between him and two colleagues to build a service for commissioning NFTs, or non-fungible tokens. Essentially, an NFT portrait is a unique digital icon that can be commissioned and purchased for a minimum of 0.2 ETH, which today is about $550. In that experience, Mark realized the benefits of rallying around an idea where partners were both mutually incentivized intrinsically through a shared mission and extrinsically through ownership. It was this model that would form the basis of Myco. Myco, a recently funded venture, allows any community working on any idea to transparently share ownership in the community through a profit-sharing mechanism. Unlike a cooperative model, Myco communities decouple the ownership rights associated with a cooperative from the governance rights. And best yet, you don't really need to know anything about Web3, crypto, or blockchain to participate. In the interview, we touch on the Myco business model. We go from there into the challenges in today's world of providing ownership to a broader class of laborers. And in many ways, Myco is a key missing link in the shift to the ownership economy. It makes it easy for community members to divide and share the economic returns from a mutual project. We hope you enjoy this week's episode.
So, Mark, thanks for joining us today.
Thank you so much for having me.
Yeah, and the audience can't see it, but you're sporting a really nice Myco hat, which we all hope to get our hands on. And before we jump to the interview, just so everyone knows, we are both investors in Myco, just to get that out of the way so that everything's out in the open. And yeah, well, let's get into it a bit then, Mark. Let's start with you just telling us a little bit about yourself and as a person, your background in tech and otherwise.
Sure, yeah. Well, yeah, thanks for having me on. Let's see, my background, I'm Canadian. My background is in kind of computer science and business. I got really lucky to kind of be thrown into the crypto space way back in like 2016, first as like an intern, eventually as like a builder, mostly focusing on like smart contracts and kind of like POC type dApps, really just trying to build MVPs for interesting things that were coming up. Ended up going back to school after my internship at Consensus and building a product called the Bounties Network that was all around incentivizing people to do various different types of tasks, paying in different tokens, which was like a big problem people had sort of in the 2017, 2018 vintage of ICOs. We ended up kind of shutting that project down or sunsetting that project. It was a little bit too early to market, but a lot of that thinking and a lot of that work has now gone into Myco, which is a platform for communities that want to incentivize their members.
Awesome. And yeah, you were definitely ahead of the game on bounties. Myself being in and out of a bunch of DAOs, I can definitely see the need for something that's a cross-bounty network. In fact, there are a number of companies out there doing this now as we speak. So that's pretty awesome. It sucks to be ahead of the curve.
That's okay. Yeah, it has its, it sucks to a certain degree, but also we worked through a lot of really hard problems at the time that a lot of these sort of like 2018, 2019, 2020 vintage of like bounty platforms, or even the newer ones, are still working through, which is like interesting to see. And I always try to give them free advice and none of them ever listen to me, which is fine. But a lot of that, like I said, yeah, a lot of that work has gone into Myco and a lot of those lessons. So it's still very valuable. Yeah.
Mark, can you just give us what is a bounty, just like at a high level?
Oh, well, at a high level, it's just like a task and with a reward associated with it, right? So a bounty could be for finding a bug within code, but we were particularly interested in bounties for non-technical tasks. So designing a logo or translating some copy or kind of anything you might do on the internet, a lot of social related tasks. We were kind of trying to experiment with like, if we could think about having these like generalized incentives, paying in these native tokens, like what is the breadth of different types of tasks we could incentivize people to do. We ended up doing like a trash cleanup, a ton of different things.
Great, thanks.
Pretty cool, man. And I think, the Web2 businesses, like you said, there are a lot of parallels to this, but it's funny how much they pale to Web2 businesses, right? There are some that are like, $2 million bounty for finding a bug in wormhole or something, right? And
Right.
then if you compare it to like the SEC's bounty program, sometimes you got $25 million payouts and stuff like that. It's pretty interesting, but
Yeah.
cool, man. So it looks like, so your journey in Web3 then began a few years ago. You have a computer science background. You came up through Consensus, which is a great trap. A lot of people came up through that. What really caught my attention though, and our attention back when we reached out to you, was that you have this focus on communities, co-ownership, cooperatives. And so we talk about that stuff a lot here. And it's also seeming to pop up in the last year on the radar of a lot of other Web3 people, folks like Friends with Benefits had a great post out a few weeks ago. And there's, Nathan Schneider is coming up in the space, who was on the first episode of the podcast. How did you guys get involved in this idea of like communities, co-ownership, cooperatives?
That's a great question. So, I mean, a lot of the work that went into Myco, the sort of like before we even launched the product, the sort of pre-work, a lot of it was around sort of my personal journey, just trying to understand like, what is this pattern for communities to be able to come together, like groups of people, let's just say, being able to come together, sort of like launch a token or do something related to that and like create valuable output in the world, right? Having seen sort of the Bitcoin project, achieve success doing this, Ethereum now, and sort of many others, trying to understand like what is like a generalized pattern we can apply to like any group of people or any problem. And one of the kind of primary things that came up was this idea of like ownership or having a way of rewarding individuals with kind of like stake in the thing that they were helping to build. And so that kind of launched us down this rabbit hole of like, okay, well, what does like the ideal form of ownership look like? What are these different ways that communities can confer ownership on their members? And, what we eventually discovered was that like most types of what people call ownership in the context of Web3 is not ownership. Because for us, like what we realized was the most valuable, and this was what was missing in most sort of ownership related products, was the idea of like economic ownership or like profit rights in a very practical sense. And so a lot of our sort of reason for wanting to build Myco was so that there could be a platform where, communities that wanted to just kind of like build in private without ever needing to, ask permission from the market, so to speak, right? Or, a bear market proof pattern for building like successful communities. What would that look like? And how could we bring that to people? And what we realized, was profit sharing tokens or shares, practically speaking, were the most meaningful way to do that, which is why that's kind of the design pattern we ended up going with on Myco.
Got it. And so I'm not going to put you in this spot, but I'm like, oh, is it a security? No, we're not going to talk about that unless Martin wants to jump in and start poking at that question.
I'll say
I'm interested in the structure, but I don't want to derail the interview. So
I'll spend a moment on it. Basically, what
Please.
It hinges on is this idea that like a security that is sold is under the purview of the SEC, right? And selling securities is typically what is like extremely illegal. If a security is rewarded to an individual who is a contributor to a company or a contributor to an LLC, the way that it's viewed in the eyes of the law is quite different. And so that's the sort of reason why, again, like I said, we don't let, shares on Myco are not tradable. They can't be sold. They can only be rewarded to contributors, people who are actually doing work. In theory, in the future, they might be able to be, you might be able to like invest into a community and get some shares back, but there's like still legal nuance that needs to be figured out around how to do that in a way that's like compliant. But ultimately speaking, like the by making the tokens not tradable and only rewardable to individuals who are actually signing legal documents as members of an LLC, it becomes much more legal.
Do they have to be rewarded at fair market value, like a stock option?
It depends on what fair market value is for a community that the short answer is like it completely depends. It completely depends. I don't want to, that's like an accounting question. I'm not an accountant and I can't give accounting advice. So I don't have an answer for that, but they can be rewarded as much as somebody believes, like as the group believes is meaningful as a reward for the tasks that they're rewarding, right? Ultimately, like there's been some SEC cases where like it was clear people were like trying to do a token sale, but sort of pretending like someone was earning tokens for tweeting, when in reality they also had to do some transactions as well to like deposit money. So essentially they were just circumventing that rule. That obviously is not kosher. But in terms of being able to just like reward ownership shares to individuals who are doing work, there's nothing illegal about that. And the sort of like final piece that I'll say, and this is the way that we frame the problem, is like the shares are meant to, like, the way that the shares work is ultimately they're just a system for tracking who has contributed how much to this sort of collective effort of this community, right? And so with that framing, like, it sort of doesn't matter what, like, sort of like value of these different shares that are giving out or whatever, because ultimately speaking, like, if you are contributing to something and are owed like a share of profit rights from that thing you helped to create, the value of those future profit rights is like sort of irrelevant to a certain degree. I think, again, there's like a lot of complexity there, and I'm not a lawyer, so like I maybe it's worth moving on, but
yeah,
but that's at least how we think about it.
Maybe it's worth just framing kind of how it works in a traditional company, because in a traditional company, if you awarded stock options, those stock options, you would have to do a kind of a evaluation of the company to better understand what the value of the company was at the time that the stock was awarded, so that the person who received the option didn't have a taxable event, right? And so the entire kind of framework for awarding stock options was done in a way assuming that an employee wouldn't have access to capital. And it sounds like there's some nuance here in how you set this up, and maybe we can follow up after the show and put some more kind of meat on the bones in the show notes around this.
Yeah, absolutely. Would be happy to do that.
Super cool. Honestly, thanks for the diversion, because whenever Martin goes on one of these things, I learn like 10 new things about securities law. And, it's important if you're going to be out here, folks, putting money into random startups, YOLO. Anyway, so one of the other things, coming up on this community building thing, which, really caught my attention. I mean, that's the thing that pulled me into this and got me in your DMs, basically. You mentioned this interesting idea around community focal points. They're key organizational patterns that bring communities together, and every community has one, right? So one of the things that we've seen out here, which I love about you folks, and, I've already said I'm not partial in this interview, so sorry, everybody. But one of the things I really love is, in Web3 in the larger community, a lot of the criticisms you get are that, oh, well, if you want to participate, you got to buy the token, or you have to do something, you have to pay somebody to do something. And so turning this around, to you folks, you've taken a unique approach here where you're basically like, well, labor and other patterns can really contribute as well. So for you folks, you've opened up another design space around community building here. So what are the pathways forward that you see in the next 6 months or year for community building, given that you've opened this up as a way to enter?
That's a great question. I mean, I think, like I said, our focus is on communities which can grow without permission, right? Like kind of bringing us back to our original roots in crypto, where people, and it's a very sort of anarchist idea that you might be able to like build a new system within the shell of the old one without ever needing anyone's permission or without ever asking. And that's a lot of our perspective with regards to kind of like how these groups interact with the free market, right? Whether individuals are required to purchase the token, for instance, that's like a pretty big, factor for like what limits a lot of participation, I think, in a lot of DAOs. But more importantly, like the reality being that when the tokens can't be purchased or sold, it encourages a sort of like different orientation between the individuals getting the tokens or shares or whatever, and the group they're getting them from, right? Because ultimately, you are at that point speculating with your time rather than speculating with your money. And we know that a majority of people in the world have a lot more time than they do money. And so we kind of think that this is a much happier path for DAOs to be able to grow kind of like in perpetuity and scale kind of like to millions of DAOs, because they don't require people even thinking about, how do I provide liquidity for my token, or what happens if the price of my token is crashing, or, vice versa, like what happens if the price of my token goes 100x and now membership is super expensive, or any of those problems. We kind of let you avoid them and say, shares are a way of tracking your percentage ownership over this thing that you're helping to create. But ultimately, like, you shouldn't be worrying about sort of like the IPOing or the public markets aspect of your community until a much later stage, right? And this is like the reason why most companies are not public in the early stage, because it's just such a high amount of overhead that needs to go into sort of managing that. Our goal is to kind of bring DAOs back to a place where they can sort of function much more similarly to traditional orgs, and like not worry about, taking anyone's money or investors or speculators or any of those things, which again, I don't know, today's March 8th when we're recording this, and markets look a little grim today. Who knows what they'll look like by the time this episode airs. But ultimately, even if, markets continue to go down over the next year or two, we're excited to continue helping DAOs grow and prosper in a way that doesn't require, any market participants.
Yeah, I think you backed into a number of things here that I was going to ask you about anyway, right? So I'm not actually even sure if these things will be around soon. Sorry, I have friends in all of them, but social DAOs, right? So social DAOs, a lot of the things that you're talking about, just for the, for folks listening in, what is a social DAO? You can think of it as really just a social club that then has a publicly traded token that either gates the access to that club. And that club, could be offering a number of things. It could be a community for maybe folks who are into design, folks who want to collect NFTs, folks who really just want to hang out and have dinner. There are a lot of these dinner DAO, friends with benefits. There's a number of these things, right? There's enemies with benefits. There's all these, copycats and stuff. But that's really what a social DAO is, right? Think of it as, I'm sure there are a number of these exclusive clubs that people could get into. I'm not cool enough to know the names of any of the real world ones, right? But just the ones online. So you've backed into kind of an interesting critique of some of them, right? Not that we're not pointing fingers here, but when I look at it, there's artificial scarcity around these things. There's exclusivity in labor. So where do you think social DAOs are headed, given that, you folks have taken a particular philosophy for what you're building, right? What does that kind of point out for them in their future?
Yeah, I mean, the first thing I'll say is that like everything is an experiment, right? Especially everything happening in crypto. And so the caveat I'll share before I dive into this question is like a lot of our model is actually based off of what we've seen a lot of these social DAOs do, what parts of them are working and which ones are not. And so I want to be mindful of like, I'm not interested in like shitting on any of these projects or anything like that. And if they have alternate sort of design models, I encourage like a plurality of sort of experiments to happen, and like all of them are meaningful, even if they fail. I think in general, building a community during a bull market is extremely hard, right? Like FWB launched in the summer of 2020, fall of 2020, right? So they kind of like made it in, I think, before things got like really crazy in crypto land. But for the DAOs that launched like last year, and in particular the tail end of last year, again, I don't know the stats, but I would assume that they've probably seen a pretty large decrease in active sort of participation, just because so many of the people who were coming in were what I think of as these like tourist users, people who were really excited during bull markets, but who kind of like wane when those markets cool down. And so that's part of the reason why, again, like I'd like to try to reframe away from price of the token or tokens which even have prices, because it encourages and attracts a certain speculator, and in particular one with a very short-term orientation rather than a longer-term one. In terms of what's going to happen to them, I think a lot of them will live on, or a lot of the sort of like people networks involved in them will live on. Whether the entities themselves or the DAOs themselves will persist remains to be seen. I think for some of them I think have reached escape velocity where the amount of attention they've managed to garner is hit sort of critical mass, where I think FWB is probably the prime example of that one. So all that to say, I have no idea what the next year looks like. I wish I could tell, but ultimately, like all of the experiments have been interesting, and all of those communities, whether they persist in their current form or evolve into new forms, will be cool. And I guess that segues into the sort of other topic of like forking communities, which is like communities can fork themselves. They could fork away dormant members. If they need to do that, they can fork their token and launch a new one. Like, because they're entirely social entities, and that is like a recognized fact, it also gives them a lot of flexibility if the remaining members can coordinate around new shelling points or new tokens or new models or new frameworks or whatever they want, basically.
Yeah, it's funny, when I was reading some of the writing you folks have put together, I was expecting you to say shelling point more often.
I try to avoid using that word. Focal point is a much like nicer word, and semantically means basically the same thing. Excellent. So yeah.
Exactly. Yeah. And that's great, because you saved me the extra explainer, folks. That's all a shelling point is. Think of it as just that, right? A place that gets our focus because of some economic incentive or some concentration of attention. It's as simple as that. Cool. So I think you backed into some really, again, you keep doing this. I love it. You keep backing into a number of interesting points here. If you start a social DAO, or honestly any DAO, you have to have the 5, 10, 100-year view a lot of the time. And I think that's what founders, especially before Web3, the ones that made it in a lot of ways, and this is not a judgment really, it's more like it takes an extreme amount of luck as well, timing and everything. But you're going to have, depending on when you start, it's going to be harder or easier to raise capital. And maybe coming into the tail end of last year, it might have been harder. And so when you think of community-owned projects, especially like our background, mine and Martin's especially, we've been in the social impact space, cooperatives ourselves, hands-on in a lot of ways. And those are areas where historically it's been harder to raise capital. And we've had to resort to other funding mechanisms. And one of the things that really caught my eye with what you folks are doing is the way that certain communities have been able to bootstrap themselves, bootstrap abundance on your platform. So can you maybe walk us through one of those examples, perhaps Pixelpunks?
The Pixel Portraits project, yeah, is a really great one. And actually, this is like, funny enough, was sort of a side project. It started at least a side project of mine, really, where a friend of a friend I'd been introduced to was interested in this new sort of primitive of NFTs. And out of nowhere, we kind of just started working together. And he had another developer friend, and the three of us kind of joined forces. And actually, a lot of the way that I think about like DAOs and collaborating, especially in these sort of more collective type communities rather than the sort of social clubs, which are quite different, has come from this experience where, ultimately, like, all that really matters for a lot of these projects is like a human attention at the very beginning, right? Like, if you have a group of people who all sort of believe in the same vision or goal, who want to work together and are sort of like activated or energized enough to be able to do so, all you need is this sort of system to track who should get how much of the pie and have them start doing it, right? And ultimately, with the hopes that in the future, if some revenue is earned or some profits or whatever, that revenue would be shared based on those sort of like agreed upon allocations, or the ever evolving allocations if they use like a more dilutive model, right? And so that was kind of how Pixel Portraits came to be. It wasn't, we didn't build Pixel Portraits on Myco. We started just doing it manually. But the lessons we learned from that was ultimately that, yeah, like, what matters the most is just getting people working, because there's so many businesses. And this is kind of how we focus with Myco, is like these businesses that are entirely people-based, right? Where they don't need investment up front. You just need people who have full-time jobs to be willing to spend an hour or two, every week on whatever it is the goal that they have, right? And so, like, the structure for getting people to value sweat equity is kind of like our most important task. Because if we can get people to realize like sweat equity is actually extremely valuable, and that like owning a share of this thing, if it earns money, could make you even more money than if you had just been paid a salary up front. Getting people to like understand that framing is kind of the most important problem we can help them solve, and either on Myco or in general. And that was kind of what we did with Pixel Portraits. Was we were lucky enough that the three of us all cared about what we were doing, thought it would be valuable, ended up building the projects, achieving a relative amount of success.
So it also sounds, I have a completely different framing of it now that you've explained it too, which is interesting. It's almost like you come out of the other end of it thinking of almost as if you had found a way to help communities monetize their own attention, right? Like their attention and time, right? Normally you just be like, oh, we did this as a passion project and that's great. We devoted our passion to it. Maybe we sold it at a farmer's market or, a random art thing, whatever, right? But you've actually found a way to create almost to encapsulate some kind of equity out of this and say, like, this thing captured our attention. We've encapsulated the attention in something that has value to all of us. And maybe this is now going to go somewhere. It's very interesting.
Right. Yeah. And on that abundance piece, the final thing I'll add is on that abundance piece, like, we have this hypothesis that there's all this like sort of latent, locked up value in the world from people who can and maybe should be entrepreneurs, but don't feel they are capable of it, don't have the sort of tools to be able to organize themselves, don't know how to collaborate with other people online. And our goal is to kind of bring them together, give them this substrate that makes it really easy to work with all these other people, to plug people in, and hopefully like just create a lot of value that wasn't there before. And when I say value, I mean like actual real world value or impact through actually like coordinating people, getting them to spend their time and effort, labor on a particular task, and having them achieve outcomes that like all of them might have wanted individually, but none of them individually sort of knew how to do themselves.
And in this Pixel Portraits, just to be clear for the folks listening in, if you haven't seen it, it'll be in the show notes. But the outcome that we're speaking about here is that making these portraits for people who wanted them, who came in and asked them on demand. And there's a number of other mechanisms we're going to dive into here as well. But ultimately, this resulted in something like 120 Ethereum for the artist, right?
Yeah, so a bunch of ETH has been earned. It's actually still very early. We only sold like 1,600 of our 10,000 portraits we plan on making. So if you're listening to this and are interested in joining the largest collectively created NFT project, please feel free to commission your own portrait. But yeah, we've managed to, like the portraits just resonated with a lot of people. We ended up getting a bunch of sort of large VCs like, Ben Horowitz using it as their portrait, a bunch of large DeFi founders as well. Yeah, people just took to them and really valued kind of the sort of values we embedded into the NFT, things like inclusivity and individuality, and which is especially meaningful in an NFT market, which is increasingly sort of commoditized.
Yeah, there's a number of interesting things there, right? So on the show, we like to talk about this notion of the ownership economy. And I think there's, two things that are very interesting about the things that are changing, and the broader trend that you're looking here is this person was able to access a global market of demand for people who wanted this thing, and then also build an equity stake in it over time to see that also appreciate as people came in and paid. It wasn't just paying off one up, like it, as people's attention focused on it. And there was a sense of co-ownership between you, the artist, anyone else who worked on it. You all kind of had, I hate this metaphor, but it's the whole rising tide, ships, etc. Right? I'm not going to repeat it. We're all familiar with it. But so eventually you're able to create from that about $300,000 of value from the time and attention that this meme, initially a meme, it's kind of, I don't mean an internet meme, it's kind of just a thing, a shelling point, a focal point. You were able to get $300,000 out of a value of time just from putting it in here or there on the side. So that's pretty amazing, right? So when people are like, oh, what is this whole thing? Is it a scam? I've heard bad things about it. It's like, well, labor was put in. People accepted this labor. It became a community worth $300,000, and we'll see where it goes from here, right?
Right.
Very cool. So then, one thing I found super interesting along the way too, which has implications elsewhere, is you discovered you landed upon this auction queue, right? As you were kind of going through this, and say like, okay, we want to make sure everyone can get it, but we also want to design. We might even use a market mechanism where people who want to jump ahead or people who want to pay more for whatever reason can. Right. So tell me a bit about that process. How did you guys land on this mechanism?
Yeah, it's a great question. Basically, Tom is the artist behind Pixel Portraits. He's the one who creates all of these beautiful images in collaboration, of course, with all the individuals who commission them. And so he had this idea of, portraits for, he had a really great way of putting it. He said, portraits for the crypto-letariat and the bourgeois DeFi. And it started because for him, he couldn't afford a punk. He wanted a crypto punk. He couldn't afford one. And so he drew his own in the same style. And that was actually sort of where the project came from. That's why we exist. And so we kind of wanted to make sure that there would be simultaneously a way for sort of anybody to be able to commission one. But at the same time, we wanted to be able to capture some upside from the higher end of the market. And over time, we kind of evolved and came up with this auction queue mechanism. We actually have generalized it now. If you go to commissions.studio, anyone can actually create their own auction queue now. But basically, the idea being that you get in line by commissioning and paying at least the minimum price that the artist has set or the creator has set. But you can skip to the front of the line if you'd like by paying more. And so we think that this is a little bit sort of similar or inspired by the sort of Ethereum fee model, which is partially, I think, where the inspiration came from. But it creates a semblance of fairness where simultaneously you can capture both the sort of FOMO or the high end of the market where people with too much money are looking for reasons to give it away. And then vice versa for the low end of the market where, people just want portraits. They want to feel included. A lot of people are buying their first NFT, Pixel Portraits are their first NFT. So we wanted to enable that as well. And we're happy with the mechanism that somewhat enables both. Super
cool. And so what were the trade-offs, if any, with this mechanism, right? Because if you look at it, right, some people might, oh, well, rich people can skip the line. The thing that appealed to me, which I'm prone to look at things this way, is, well, actually, they set a floor price where anyone can get it. I mean, of course, I don't mean anyone. 0.1 ETH is still a ton of money for a lot of people on Earth, right? So not everyone, right. I'm not here to litigate that with you. I'm just stating that plainly, right? But when you think about this auction queue, what were some of the learnings you had here? Where else, you open sourced it for the sound, or at least you made it freely available. What's next for that mechanism for communities on your platform?
We have no plans. I mean, like I said, it was purely sort of a side project for us, right? And a lot of it was, when interesting kind of projects cross my sphere, I try to pay attention to the ones that I think will be most meaningful. And this was kind of a fun experiment. It was also a way for me to keep my Solidity skills sharp, as I hadn't been writing Solidity for a little while. So it had a very sort of tactical purpose there as well. But in terms of our plans for the future, we don't really have any. We think it's actually just really early. We're really bullish on this commission-based model for NFTs, but it hasn't done as well as we had expected. We think we're just a little early to market. So we don't have any like specific plans for it. Anyone can create their own commission queue if they'd like to sell their own sort of services or goods. I think, some of my time set up on a queue as well if people want to buy 3 hours of my time. The minimum price is very high, so I apologize in advance. But ultimately,
what is the minimal price?
I think it's like 1 ETH for 3 hours or something like that. Basically, someone paid for my time and it was much lower. And I realized my time was way more valuable than what I had originally priced it at. And so I said like, okay, now it's this. But I also like, the other element is I did it. I had a commission come in and I did it. And I basically helped these guys like re-architect their entire crypto startup in like 3 hours of my time. So I realized it was relatively valuable. So now that queue is set up, and if anyone wants my time, they can look for it there. But going back, in terms of next steps, yeah, we don't really have any plans for it. We think it's a cool mechanism, but no specific plans. And hopefully if other people find it interesting, they'll either build on top of it or use it or anything they like.
Awesome. And so it's now, correct me if I'm wrong, it's now a co-owned community on Myco, right? If we went to myco.space today, we could find it.
Yeah. So the Pixel Portraits is on Myco. Yeah. We're still kind of trying to figure out what we want to do. I think at some point we had a big plan where we wanted to kind of create a social club out of the Pixel Portraits. We since have kind of walked back those plans, just recognizing that most of our members don't need it, don't want it. There's sort of an abundance of social spaces right now. And most of those members like weren't looking for a new one in particular. So we still, we have like some plans around the co-ownership piece, but they're still being developed. And we aren't sure that it quite makes sense to turn it into a kind of a social community in the way that we've seen a lot of them play out before. Because like I said, like the people don't want them. And we'd rather not like graft that onto the project later. We've never had a Discord. We never needed it. People just found us on Twitter and, from the other people who had portraits. And we kind of like keeping it that way for now. In the future, things will probably evolve, but for now, it's okay.
Cool. And then so digging a little bit deeper, not into the Pixel Portrait specifically, but just communities on your platform in general, right? Co-ownership, I think, is still a poorly understood idea in general. When when I speak to someone about like, well, I worked for a cooperative for, over a year, and it's majority owned by its member owners, right? And then if you're like, oh, what is that? How does that work? And, you kind of explain it where it's like, one member, one share, one member, one vote. And, gives you rights to, participation in the cooperative in terms of profit sharing and what have you. And then people go, oh, that's a thing. Wow. I had no idea. So for you folks, this is, like I said, keep saying it's the thing that really attracted me to what y'all are doing is you're really trying to scale, bootstrap and scale co-ownership as a thing. So what is co-ownership? How does co-ownership work for communities on your platform?
Great question. Yeah. So as I mentioned earlier, like the way we think about co-ownership is we think of ownership as economic rights. So we actually have decoupled governance rights away from those economic rights in such a way that we can have a method for tracking like how much of the sort of profit rights you have at any given moment, but that governance rights or decision-making rights are separated. There's like some small cases where members have some legal rights to, I think it's like 2/3 of members can come together and vote based on their shares. But there's like only one sort of specific edge case where those shares are actually used for voting by default. And then the way we think about it, and it's also, I guess, worth noting is that on Myco, a lot of the co's, when they start, are somewhat centralized, where every community has like a creator or a set of creators who have a bunch of permissions. And then, by default, everyone else is a member who has, whatever permissions the creators grant them. And over time, creators can grant sort of more permissions to either their members or, voters based on their shares. So by default, co-ownership is exclusively dictated. Co-ownership exclusively dictates your profit rights, which we think is like kind of the most meaningful part of ownership. When people talk about owning a piece of something, they're typically talking about the like economic rights over the thing rather than governance. Governance is something people should be paid for, not something they should pay to have the right to do. At least that's the way we see it typically playing out. And I think a lot of DAOs are seeing it play out that way as well. But the other element around the co-ownership piece, and this is something that we do that we're still kind of continuing to develop, but is a little bit on the cutting edge, is around this idea of like dilutive ownership. And we have a kind of new model that we're pioneering where, communities are on a regular basis, let's say every month, creating like 1 million new shares. And the community's only job is to give out those 1 million shares that month. And they can do this, every month again and again, and, make adjustments who is getting how much of a percentage of that month's ownership month over month, so they can sort of dynamically respond to their environment. But more importantly, that like your ownership in the community is made up over sort of many months worth of shares, right? Like if the community's been around for 10 years and I just joined now, there's still new dilution that's there to incentivize me. But ultimately, all those old individuals who were there in the community as well still might own their shares. They're just getting diluted slowly month over month. So that's like another sort of framing on collective ownership that we're trying to think about, which is this idea of, as you kind of mentioned, the like rising tide lifts all boats. The way we think of it is like, you're much better off owning a smaller share of a larger pie. And it's really hard for humans to do this math. Humans are extremely bad at giving away ownership. When you ask somebody how much of something they should own, they will invariably estimate a higher number than what is actually fair when you adjust for the number of people in the thing, right? And so like the reality is like our job is to encourage people to take less ownership, recognizing that the trade-off is that they get more co-owners and co-builders with them, and that the thing they build together is worth much more than it would have been if it was just theirs.
So just 2 follow-ups on that. So can you explain the difference between what you're doing and what, say, Fairmint is doing? And then I want to come back to the accounting question again, because I think like it's useful to kind of talk about it a little bit in the construct of a traditional company. Or my understanding of Fairmint is effectively you've got kind of this continual equity offering that happens, and an investor can effectively put their money into a consumer, or anyone can essentially put their money into a particular brand or startup that they're interested in, and it automatically calculates the price based on the previous offering and the amount that's been raised, and effectively the price just grows over time when it tries to simplify raising capital by essentially making your fans or your customers or evangelists and co-owners in the platform. And it sounds like here, people just aren't putting in money, right? They're using their labor. And that's the biggest difference.
That is definitely the biggest difference. I think Fairmint's model is definitely very cool. It's, from my understanding, it's similar to like a Uniswap pool, but for equity in a company or something like that, where it's sort of at any given moment, investors can be like sort of buying and selling into or out of the equity. And that's like kind of how you get this like market price. And then, as people are buying more and more, if no one else is selling, then the price goes up. So I think it's definitely like an interesting model, especially for like, groups who are fundraising. Like I said, our model is all around like labor contributions and then specifically focusing on dilutive models of ownership. Again, like very little to no research has been done, at least that we've seen, or experimentation has been done that we see in sort of organizational theory around dilutive models of ownership, right? Typically, when we think about shares, and we get this from like LLCs, right, is they have like very fixed ownership. And most of the time, because the framing around companies is based around investors, or LLCs were created to, allow people to invest in partnerships essentially, right? So like most of the framing has been around capital contributions. Very little framing has been around labor. And when you remove the idea of capital contributions, the way that like it actually sort of starts to benefit you much more to have a dilutive model, because the people who are sticking around, who are continuing to be there, will accrue more ownership, relatively speaking, and the ones who kind of like depart will get less.
Yeah, so I like this kind of perpetual kind of continual issuance of new, for lack of a better word, shares. I mean, it's more of a profit interest. I guess like where the model could get really interesting based on the number of projects or the number of kind of communities or entities, whatever you want to call them on the platform, is you're going to actually have kind of some correlation analysis between the incentives that have been developed and what has been incentivized within each of those communities to actually provide advice for each of the communities on what should they pay in terms of ownership for a particular action that a community is incentivizing, right? And then over time, you can probably even determine kind of back into, and it sounds like this is where you're going to have to go, I think, as you become more successful, just because of the law, you're going to have to kind of say, this is the fair market value of the company. And you can actually kind of essentially help a whole class of people that don't have access to understanding ownership today, learn about how they can become owners, learn how to properly value their actions, and how those actions can then become something that can decouple their labor from how they earn a living over time. So they can put some kind of work in for the next year or two. They can build up a stake in one or multiple communities. And then over time, this can be kind of a security that they rely on later in life, if something happens or as they age, which is really the challenge right now within the SEC framework, right? Because effectively, we've got this society where 80% of the population doesn't have access to these securities. And so pretty much all of our macroeconomic policy doesn't really work. But that's my understanding, what I think is really kind of intriguing about how this flywheel kind of goes over time and where the real value is in what Myco is doing.
Yeah, no, you're absolutely right. And, again, going back to this idea of like speculating with your time, the idea, the hypothesis we have, right, is like, and I'll give you an example. I'll do it by a case study. I have a friend, Jordan. Jordan has a great understanding of like the gig economy, or not the gig economy, the creator economy. He is on TikTok, he's on YouTube. And for whatever reason, he just is good at spotting stars. He just knows when someone's going to pop before they've popped. He just sees it. And what he complains about is like, there's no way he can like speculate or have upside in this idea, right? And of course, like there's some big version of the world where everyone has a token. I don't want to live in that world, so we like won't really consider it. But like the way we kind of like hope the world will go is people like Jordan can look at communities or look at creators who need help and evaluate like, okay, well, even though, yes, this is quite small right now, I do think this will be much larger in the future. And so I want to earn some shares, which right now might be worth very little to nothing on paper, right? And I think that's the important caveat for what you were saying about the taxable stuff is like, in theory, at the beginning, before they've earned any money, before anything, like the book value of the company is zero through sort of like most lenses you might be able to evaluate it, right? And so when those shares are earned, especially in those early days, the like sort of taxes you might pay on them are quite low. And it's sort of like all like the risk is there, but you're not having to put money in or anything like that. And kind of to your point, yeah, like this hopefully enables a lot of upside to float to sort of like the 99% who don't have access to deals before they reach public markets, which we think is super unfair. So yeah, you hit that nail on the head.
Yeah, I think one other thing that could emerge from this, right, is like securitization of labor, right? Where you've got groups of people that come together and they essentially allow themselves collectively to be securitized in ways like your friend Jordan, who wants to back creators, but doesn't have any way to bet on them. And that's something that I think has historically been kind of something that's been kind of a not shady area, but that there's been concern around it. You obviously had Bowie bonds back in the day, which were used as kind of as collateral from the royalty streams on current and future album sales. But it seems like there's more and more of that opportunity over time of kind of backing groups of people that have yet to create value in platforms like this.
Right. I will say again, like, because of the legal aspects, we generally don't think about the sort of investor user flow as much, or really at all. Most of what we focus on is kind of this like early stage problem that you actually highlighted, which is like, how do you figure out how much to incentivize to different people? And that's kind of like primarily what we focus on, is like making sure that communities are intelligently able to like price different tasks or price different efforts, basically, or functional sort of, maybe not functional roles or functional groups or something like that. That's like primarily what we focus on, and not this idea that people might speculate with their money, because the relationship that somebody has when they're investing in somebody with money and expecting a monetary return that way is extremely different than the one that Jordan might have, for instance, if he was betting on an early YouTuber and actually like worked with her to help her do her intro video or whatever. The relationship they have with each other is quite different. The relationship he'll have with those shares will be very different also. And that will eventually show itself when times get hard, or, when upside comes in and he has the opportunity to sell or do something in a way that she might not be, happy with.
Well, I think it's really well put. It's really well thought out, and it's kind of admirable. And so I think there's a lot of potential here.
I appreciate that. Thank you. The tax stuff is hard though. So there's like still,
but I think kind of the place that you're at, in kind of where you're at in kind of 2 years into this venture, and the life cycle of the venture is like perfectly timed with how the SEC is thinking and how the SEC knows that it has to evolve. Like if you started this 5 years ago, I don't think it would have worked, but I think there might be a real opportunity here.
Right. And our big thing, and if anyone from the SEC is listening, please listen carefully. Our big thing is like, we never want to help people like avoid SEC regulations. We think that like a lot of the spirit behind those regulations is like sound and like just needs to be, yeah, like you said, it kind of evolved and upgraded to reflect kind of more modern ways of like working, which I think there was some efforts that was done with regards to like, I think Uber drivers or Uber wanting to give shares to its drivers, that I think we saw sort of a small inkling of this, but I think we'll see much more of it over time, especially as hopefully as more people start making money on the internet and more of that sort of like very efficient, dynamic entrepreneurship can rise.
Yeah, for sure, man. And I think that like in some ways you could, and again, no one come after me for this, but in a lot of ways, the vision of some of the ecosystems out there as well is that this is an internet of money, and any community might be able to make its own sovereign money and say like, this is what we value, right? And eventually at some point, not today, but in the future, being able to move money from one community to another for exchange of goods becomes possible. And at that point, I'm not a lawyer, I'm not an expert on these things. I don't know what they end up looking like or what they all actually are as instruments, but that part I leave to the experts. But it's clear that it's kind of happening within a lot of the blockchain ecosystems out there, particularly if you look at something like Cosmos and the internet of blockchains and the stuff that they're with philosophy that kind of drives them. So coming back around to this idea of your dilutive DAOs, hopefully we can probably hit a couple more points here and then send you on your way. So I think, as Martin said, you guys have really come a long way in terms of thinking through the design of these communities. How should founders who are thinking of building community first companies, how should they heed your advice? Where would you tell them to start?
Well, that's a great question. The first piece of advice I'll give is like, the first model you come up with will invariably be wrong. So set yourself up in a way that enables you to fail. That's like kind of the primary advice I'll give you. The other advice though is just like a practical one, which is like, there's a certain degree of onus that falls on the shoulders of founders. And actually the same is true for traditional companies, like, and just giving out equity, right? Where if you give out too much equity too early, there won't be enough left over for sort of like later stage employees. And I think the same thing is true in the context of giving ownership to your community, right? You might be able to build your company for a certain period of time without giving away that ownership, but eventually that day of reckoning will come. And so, for us, like with Myco, 50% of our profits will always flow back to our users. We have our own co on Myco for our users, and we give shares out to people who are contributing to Myco, who are kind of external to our company. And we've pledged that 50% of our profits will always flow back to them. And so we did this and we sort of put this like flag in the ground very early in our life, so that because we knew it would be harder and harder to make that promise later on. And so the like earlier we can make that pledge and commit to that, the better. And also so our investors all know that like, this will always be there and it can't be removed. But yeah, like just like recognizing the value of like collective ownership, recognizing the value of like having many people on your cap table, like it's actually like a strong benefit, especially early on where those individuals can be your largest supporters. This was kind of an insight we had with bounties. I'll go back, maybe we'll go full circle because the podcast is almost done. One of the most interesting things we realized with bounties was the fact that like when you paid someone with your token, right? If I was, let's say MakerDAO, and I was paying someone with Maker tokens, what happened was that the individuals you were paying weren't just like getting these tokens and then immediately selling them. They had this sort of like relationship with the company that was actually some of the most valuable marketing that company could have asked for, right? Every time you pay someone with your own tokens, you're creating this relationship of employer-employee. And for whatever reason, people love their employers, like because we love getting paid. I don't know why. It just like is a reality of the world. And so like there's a certain degree to which like you want to turn your most loyal fans into co-owners because it will actually make them much more loyal fans, and they will drive organic growth. They'll tell all of their friends, hey, you should join this thing, not because you're paying them for it at that point, but because they're so intrinsically motivated and bought in that they'll do it on their own. That's the value of the collective ownership. That's why platforms need to give their users fair value back, not only because those users did work and contributed, but more importantly, because it's actually value accretive back to the company in the first place.
Yeah, I think that's 100% spot on. It's basically a big thesis for why Martin and I roused ourselves into starting this podcast, right? Is that, you hear we're in, I don't know, what is this, 2022? We're probably in like year 10 or year 8 or so of hearing about network effects, right? How old is NFX, the venture firm built around this, right? And they've been putting out stuff around this forever. And of course, A16Z and everyone else been doing it too. And I'm not pointing any fingers here, but I feel like we are just scratching the surface of network effects. And that's what you folks are really doing there. This is why you caught my attention, which is that you're on the bleeding edge of incentives and really bringing out the full value of network effects, right? Because it's like this being able to pull people in and say, look, I did labor here for this community. We built this thing together. You should join in too. You can get a piece as well. And actually, it's not finite. There's enough of it for all of us, right? Like that's a powerful effect. And like you said, it blends, it's a unique blend of the intrinsic and extrinsic motivation, right? Because they're both coming together in a way where you're seeing your wallet get money for your participation in it. And then you're also seeing your contribution get the brand and everything else out there more. And so that is, I think, a powerful combination and really like what community first companies can really put out there and what they can learn from you folks. So that's awesome, man.
I'm hoping. Yeah. There's the final thing I'll say on the extrinsic piece is like when you give somebody shares that are essentially sweat equity, that have no par value, that are not meaningful, that have not even necessarily like an exit path. It is a combination of both extrinsic motivation because they've been paid, but intrinsic also because the only way that those extrinsic incentives are actually valuable is if they are intrinsically motivated and they're like values aligned and they actually believe that they will be. So like when you give somebody sweat equity shares, you actually get the best of both. It's a very rare situation because it's really hard to do both. Most of the time when you give somebody extrinsic motivation or extrinsic incentives, the intrinsic ones like go away. It's very hard to have both simultaneously. And when you give sweat equity, it's the only case we've seen, or I've seen at least, where you can actually get the best of both, which is why partially we're so excited. And we're actually about to turn the engine on. We're like, things are heating up at Myco. We're about to do a big release next week. By the time you're listening to this, our new UI will probably be up. We'll have a bunch of product updates. So please feel free to join us on myco.space. But the engine's about to turn on and we're really excited for kind of like what's going to happen. If you believe in any of the mission or vision that we've shared during this podcast, feel free to join us. You'll get some shares and you'll be able to speculate with your own time and your own effort.
Awesome. And I think I'm really glad you beat me to this. You know, you're a Web3 native person. You beat me to the shill. Good job. Good. This is normally where I stop and say, please, shill, tell us where to find you on the internet. But awesome. Yes, that's myco.space. Definitely pay attention to these guys. And we'll definitely find a way to participate for sure. Connect our wallet and definitely or log in and view these things. That's one of the cool things is that we've said all these buzzwords, and I just want to take us home for one more thing here that's important to know about the community first approach you guys are taking. This is actually not necessary. You don't have to have a fancy wallet. You don't have to have anything else to join Myco, right? All you have to do is show up and create an account, and it can be done through Twitter. It can be done through Google. It can be done the old-fashioned way. So don't be scared. You can find a way to participate in Bootstrap abundance. So
absolutely. Yeah. Myco is a product for non-crypto native people. Even if you don't understand anything about crypto, that's totally fine. Myco is a great way to make money with your friends online. Crypto is just the way that it is possible. Oh, and also I'm at Mark Beylin on most platforms on the internet. If you ever want to find me, I'm always happy to chat about this stuff. Feel free to reach out.
Awesome. Thanks a lot, Mark. And we'll, m.mirror.xyz if you want to see the amazing stuff they put out as well, their thought leadership pieces. And yeah, thanks a lot for your time today, Mark. And
so much for having me.
Myco.
Thanks so much.